All right, let's get into it. Today, we're going to cut through all that market noise and find a real moment of clarity. We're building a blueprint for a trading strategy that's all about structure and predictability, not just guesswork. So let's dive in.
You know that feeling, right? Staring at the charts, just feeling completely overwhelmed by the wild swings? You're not alone. It's so easy to feel like you're just reacting, always one step behind. But what if you could learn to anticipate what's coming instead of just chasing it?
Look, the London and New York sessions, that's where all the action is, for sure. But that action, it comes with a ton of noise and volatility. The Asian session, though, is different. It's quieter, more deliberate. With fewer people trading, the price action is just cleaner. This isn't a time to log off. It's a seriously overlooked edge where you can see the day's story starting to take shape.
So, here's our game plan. First, we're going to talk about that overlooked edge. Then, we'll dissect the anatomy of the Asian range so you understand why this whole thing works. From there, it's all practical steps, finding the perfect setup, spotting your entry, and setting logical profit targets. By the end of this, you'll have the complete blueprint ready to go.
Okay, first things first, the anatomy of the range. Look, before we get into the how-to, you absolutely have to understand the why. Knowing the logic behind a strategy is what gives you real, unshakable confidence in it.
So what exactly is this Asian range? It's really simple. It's just a period where the market isn't really trending up or down. It's just moving sideways. Think of it as an 8 to 10 hour nap for the market. But this isn't random. It's an accumulation zone where the market is coiling up like a spring, just getting ready for its next big move.
So what's happening behind the curtain during all this sideways action? Well, orders are piling up. You've got buyers putting their stop losses right below the lows and sellers putting theirs right above the highs. And breakout traders, they're putting their entry orders in those exact same spots. All of this creates these big, juicy pools of liquidity just waiting to be grabbed.
And you know what? This is predictable because human behavior is predictable. Traders see a clear ceiling, resistance, and a clear floor, support. So what do? They place their orders at these obvious levels. This collective action creates these familiar, repetitive patterns on the chart, patterns that we can actually learn to read and get ahead of.
You know, here's a really simple way to think about it. The Asian range, it's like a bus stop. A whole crowd of orders gathers in one predictable spot, and they're all waiting for the bus, which is the huge volume and volatility from the London session, to show up, pick them up, and start the day's real journey. Our job is just to figure out which way that bus is actually headed.
All right, enough theory. Let's move from the why to the how with the perfect setup. Because let's be real, not every Asian range is worth your time or money. The key to consistency is learning how to filter for only the highest probability days, and that's exactly what we're going to do now.
The very first step is to validate the range. It's just two simple checks. First, is it actually consolidating? Is it clearly moving sideways? If the market's already been trending up or down, just forget it. The setup is invalid. Second, check the size. We want a nice, tight range. A good rule of thumb is to compare it to the average daily range, or ADR. If the day's typical move is at least 3 times bigger than the little Asian range we're looking at, that's a fantastic sign that there's plenty of gas in the tank for a big move later.
And this slide just shows you the difference perfectly. Over on the left, that's a good range. It's tight, it has clear boundaries, and it's building up all this potential energy. On the right, that's a bad range. It's wide, it's already been trending, it's messy. We learn to completely ignore the stuff on the right and focus only on the beautiful setups on the left.
Okay, so we found a valid setup. Now for the most important part, spotting the entry. This is where we learn to stop guessing and start acting with real precision.
Now listen up, this is absolutely vital. Amateurs, they chase the first breakout. They see the price pop above the high and they jump in, smashing the buy button. But professionals? We know this first move is almost always a trap. It's what's called a liquidity sweep or a stop hunt, and it's designed to grab all those orders we talked about earlier. We don't chase that. We wait for the move after the move.
So price has just broken out of the range. It swept all that liquidity. It looks like it's about to take off to the moon. So what do? How do we avoid getting sucked into that trap and actually get in with the real intended move?
Here it is, the professional's 2-step confirmation. First, we wait for that sweep to happen. We let price break above the high or below the low. Then, and this is the absolute key, we look for a market structure shift. All that means is we're waiting for the market to reverse and break its own recent little pattern against the direction of that sweep. This confirms the trap has been sprung and tells us, okay, the real move is likely starting now.
Look, a great entry is only half the battle.
If you don't have a plan for getting out, you're just gambling. So now we need a plan for setting profit targets. Having logical exits is every bit as important as having a good entry.
These rules, they're not suggestions. They are your foundation. First, risk is everything. Never, ever risk more than 1.5% of your account on a single idea. Now for targets. Your first goal always should be a 1 to 2 risk to reward. Why? Because hitting that lets you bank some profit, move your stop to break even, and manage the rest of the trade completely stress-free. From there, the next logical magnet for price is that pool of liquidity on the other side of the Asian range. And hey, if you catch a really strong move, the previous day's high or low becomes your final destination.
All right, let's wrap this all up and put it together for your first observation. We're going to recap the entire blueprint into a simple, actionable checklist you can literally start using today.
So here it is, the full blueprint. 1. You identify a clean, consolidating Asian range. 2. You wait patiently for London to come in and sweep one side of it. 3. You confirm the reversal with that market structure shift. 4. You enter only after you get that confirmation. 5. You target the liquidity on the opposite side. And finally, and most importantly, number 6, you always manage your risk.
Every single morning, before all the chaos of London and New York kicks off, the market lays out a set of clues. It builds a structure, it telegraphs its intentions, and it sets traps for anyone who's not paying attention. The only question is, now that you have the blueprint, are you ready to start reading those clues?